they'll give you a dollar amount. And that dollar amount you divide either against the value of your asset or against the amount of cash you have invested in the asset, depending on what your preference is. Return on your equity or return on the asset or return on your investment. And that's how you underwrite a deal. So many people go into these things going, I can get this property's going to cash flow me $500 a month. It's a great deal. I'm going to get it now.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Hey, and welcome to the episode. Today I get a chance to talk with Dave Foster for the second time. This is a continuation of our conversation from the first episode, which if you haven't listened to, you absolutely have to go check out. But here's the thing. You ever wondered how the wealthy use tax codes, tax laws to their advantage? Well, most people are just paying and praying. Well, if so, you're not alone. And that's the thing. Talking with Dave, he talks about these tax codes. One thing in particular, the 1031, but there's nuances, right? There's additional concepts that you have to know about so that you can use the tax code effectively. And more importantly, I would say is what questions you should be asking when you would be working with your attorneys and tax professionals as well. Now, he's got some great things that we've covered today, like I'm talking about 1031. He really expands on that as well. He talks about depreciation and talks about how the government is actually your silent partner too. Now, we build with Dave on top of each of these different concepts, and this is one you're definitely going to want to pay attention to if you're going to want to get into any type of real estate investing. So, as usual, get your notebooks out, get ready to take some notes, make sure that you're getting some questions as well. You can think about, what would I want to know if I were looking to reduce my taxable income, my tax bill? What do I want to know at taxes in real estate? Get those questions listed and make sure you're paying attention to Dave here. And as usual, I'll be adding his information to the show notes along with a couple of blogs. So reach out to him, check out those blogs if you're interested in more. And as always, like, subscribe, comment, reach out to me as well if you have any other topics you'd like to learn about as well. So I hope you enjoy, listen, and I'll see you on the next one. Dave, dude, so good to have you back on the show. I had a ton of fun with you last time and talking about 1031s, 1021s as well. I believe that is the other code.
121.
What's that?
121. The 121
121
is the primary residence. Yep.
My bad. So I have to go listen to it again. But I really appreciate just having a very great conversation with you. Very genuine, fantastic guy. I love your energy and just the way that you teach. So I'm stoked to have you back on the show and give us some more teaching. For those listening, if you haven't already, you've seen Dave on a previous episode that's been published. Check that one out on what we just talked about. But here, what we want to do is fill in some of the more intro topics to round out the knowledge of getting some good education around tax as well. And Dave got some interesting twists and insights he's going to drop on us as well, which I can't wait to hear about here. So, Dave, thanks so much for being here, brother.
Man, it is awesome to be back.
Awesome.
And considering the alternative to not being back, that's a good thing.
Fair enough. So, like I said, I wanna start us off from the beginning. Tell me a little bit about this. Tell me a little bit. What exactly is tax? How do we think about tax and tax code as well?
Yeah. Well, some people would say that tax really is just the suck at the end of a good job. You do everything right, and then you wake up and here's this thing, tax.
Yeah.
And it puts a damper on everything for sure. It's kind of interesting, but yet you've never met a legislator who doesn't love it. They just always want someone else to be taxed.
Sure.
And so that's how Washington lives. It's not a question who doesn't like tax money? It's a question of who are we going to get the tax money from?
Mm.
Which, yeah, that begs a whole nother topic on politicalism. But I had a mentor once that changed my whole outlook on investing. I mean, really totally changed my whole outlook when I was complaining about taxes one day.
Mm.
You know, now the thing is, nobody's ever gone broke paying tax on profits, right? It just feels like it. But we all like to complain about it. And so one day I was complaining, oh my gosh, I got this great project I'm doing. The taxes are going to kill me. I hate this. And he said, Dave, stop thinking about the tax code as a way that the government gets into your pocket and takes money from you so they can build highways and roads and hospitals and all that. He goes, that's all true. But you will make yourself a better investor if you start to look at the tax code as a behavior incentivizer. Mom
Yeah.
and dad promised little Junior a cookie
Hmm.
if he's quiet for an hour. Is he going to try to be quiet for an hour?
Yes.
Absolutely. Uncle Sam says, I won't take tax from you if you do this action, whether it's buy solar credits, do a 1031 exchange, have children, get married. All of those things are deductions that have been built into the tax code, not because they don't want my tax dollars, but because they want me to do certain things.
Hmm.
And I'm rewarded when I do those things.
Yeah.
And that just poof, that changed everything. So I then began to look through the tax code to say, okay, what behaviors are they wanting me to do? Opportunity zones, huge example of those in recent years. They want to see money going into areas that might not be the greatest, that need development. So they incentivize you by letting you keep all of your tax dollars if you invest in those areas.
Mm.
But what a great opportunity. So then I get to have a good project, make money, and not lose money on the back end.
Hmm.
And that was actually how I found the 1031 exchange as well, way back when, because my very first house that I bought and renovated and then sold after putting a tenant in it and paid a lot of tax dollars on. I hated that. But then I discovered the 1031 exchange and went, oh my goodness, this is the answer.
Yeah.
So for those who are saying this is all Greek to me, the 1031 exchange simply allows you to sell investment real estate and using a process buy new investment real estate. And if you do it within the right time frames and you buy at least as much as you sell, you get to indefinitely defer paying tax on the profit.
Hmm. Yeah.
Why would they let you do that? You ever wonder that? Why does the IRS like me so much? I mean, they don't like real estate investors, do they? The
Yeah,
tax,
I would say they would because
yes.
the way that I remember learning about this, at least, one of the ways that sticks in my head is that the government being a silent partner. And like you're saying, being the incentivizing, if you're buying places and you're fixing it up or you're doing things like that, not only are you getting supplies from somewhere and helping to, move currency around, but you're helping to do some economic growth too, right?
Yeah, that's exactly right. This is what drove me nuts for the last 4 years because they every budget had a provision in it to eliminate 1031 exchanges
Mm.
because the complaint was, oh, it's all the rich guys game, right? We're going to take taxes from the rich, give them back to normal America. The average sales price of a 1031 exchange, a little less than $400,000.
Got it.
Does that sound like rich America?
That's the average, right? Like three something.
Yeah. So it's not the mega wealthy doing this. But secondly, and even more important, for giving up and taking capital gains tax, which is a lower rate,
Mhm.
For every dollar they would take of that, they were going to give up exactly what you talked about. They'd give up regular tax on 2 realtors' commissions,
Hmm.
2 home inspectors, 2 closing attorneys, 2 title companies, 2 handymen having to fix up things found during due diligence. They were going to lose so much in tax revenue because it was going to shut down a very critical industry.
Yeah. And
And
those
just
are all the
trolling us that they kept doing that. Thank heavens we have someone who, at least on this topic, understands real estate and is going to like the 1031 exchange.
Yeah, totally. And like you're saying that if the average house under, I think you said 400 grand, is what's being using 1031s, then that's not the quote unquote ultra rich. Moreover, the service industry around that, like the title, like the handyman, like all everyone else that lives, works, and plays in that community too, right? They're being worked with, and so there's economic activity there too.
Right. They not only are paying taxes on their activity, but they've also got jobs.
Yeah,
And last time I looked, having a job was a pretty good thing.
and having your own business, but definitely.
This is true. Not a job, have your own business. That's yeah, incentive number 2. Interestingly enough, Stephen, you can trace this all the way back 104 years
Hmm.
to the start of 1031.
Which part? Which part we're tracing?
The whole idea of the incentivizing behavior.
Okay.
In 1921, we had just ended World War One.
Hmm.
We were a growing nation, and we were very hungry.
Hmm.
We needed agriculture to develop and to develop fast. And we had all our troops coming home, needing to start farms, needing to get jobs and eat, provide for their families. There was a problem though. There was very little cash after the war anywhere to be found. So for a farmer to sell a small farm, he could not be able to buy a big farm because by the time he paid the taxes, he wouldn't have enough money left.
Got it.
And by the same token, that young soldier coming back from the war who wanted to get into farming couldn't do it because the farmers that owned the small farms
Wouldn't sell.
couldn't sell their
Yeah.
small farms.
Yeah.
Yeah. So it just was stymieing everything. So some brilliant person said, let's just not take the tax from them. And that just turned the industry on fire. Now we had activity. Now we had new people entering. We had experienced people growing, and we were feeding our country.
Yeah.
And that was the 1031 in 1921.
So that's actually when they instituted, passed
Yeah.
laws to. Okay.
Now it's nothing new at all.
Has nothing what?
It's nothing new at all.
Oh yeah,
It's been
nothing
around
new.
forever.
Yeah. Yeah. I mean, yeah, good. Since the 20s, so 100 years, right? Um, So just a quick recap there as we, just it's taxes or taxes, right? It's anything off of the purchase price or something like that, right? It's there is a percentage based on where you're at, et cetera, and that goes to good old Uncle Sam, or the municipal, et cetera, whatever, Uncle Sam and or proxy, right?
Yeah, yeah,
Um,
yeah.
and so just the same on real estate, like you're talking about with the farmer, the farms as an example. But now we have, of course, as it is the same thing with single family homes or any real estate, and of course the taxes like the income tax, et cetera, or on things like the real estate commissions as another professional involved and so forth. So okay, so we were just talking beforehand too, and you were talking about being a CPA as well. You have that perspective on tax code. Is there something additional that you wanted to talk about on tax code from your
Yeah, well,
CPA
I'm a
perspective?
decreed accountant. I'm not a CPA because I never wanted to work for a living. I'm just kidding. No, the designation between CPA and enrolled advisor,
Okay.
enrolled agent, or accountant, the CPAs are allowed to publicly audit publicly held books.
Okay.
So I chose, like you said a minute ago, to go into business for myself.
Yeah.
So I use the accounting to direct my business towards minimum tax.
Yes.
And
Okay.
so that's why I do it. So, yeah. So it's, I mean, there's just so many different ways to use the tax code as real estate investors. It's kind of crazy. I mean, when we talk about the difference between owning your own business or having a job,
Hmm.
you have a job, you get a W 2, you pay that tax, that's it in the story. If you have your own business, there's so many opportunities to reduce what it looks like you actually pay by
Hmm.
taking advantage of various deductions. The very first thing that I think is the biggest for the real estate investor is to simply make part of your real estate investing moving in and living in properties you purchase for investment. By buying it and moving in and living in it, now once you've lived in it for 2 years, you get to take advantage of that 121 exemption we were talking about,
Yep.
which isn't just low tax or tax deferred, it's tax free.
Hmm.
So, in my mind, and I know there's some huge guys out there on TikTok and Facebook that say you're stupid, don't real estate. I think they're the stupid ones, but that's me. But I think that every individual should make it a goal to become a real estate investor, at least by buying the house you live in. Why is that investing? Because all of the appreciation that you get is going to end up being tax free if you
Yep.
live there for 2 years. That's a tax free investment.
Hmm.
What's not to like about that?
Yeah, you're still leveraging it, right?
Exactly. The second, yeah, it's a savings account, if nothing else, because people say, well, you don't have tenants, you got to pay the mortgage. Well, yeah, but a lot of that mortgage is coming back to you, the repayment of the principal part of it.
Mm.
In addition to that, the interest that you pay is deductible. So if you're in the 30% bracket and you're paying $40,000 a year in interest or $30,000 a year in interest, you're cutting another $10,000 off the taxes from your general income. So, right there, by moving into it, by taking a loan out, you're impacting yourself positively as a real estate investor, even though you don't feel like one.
Yeah. Do you get to deduct all of the interest or only partial?
There's there might there's some phase outs once you get above a certain point,
Yeah.
but for the most part, your interest is going to be deductible. Part of that's they're looking to take care of in a lot of the that new sales and added value. So we're not sure where it's going to go.
Hmm.
But on the residential side, when it's your primary residence, there are some phase outs. But yes, it's still a significant chunk.
Got you. Okay. Um, yeah, and you gave some really went really in depth on that on 121 in that last episode too. But I know one of the things we didn't have a chance to talk about, which I think would be good, is to talk about depreciation. And so, can you talk a little bit about what depreciation is and how does that play a role here with the primary residence too?
No, it does not. Depreciation is only for business investments, and it's kind of like it's seen as the holy grail
Mm.
of tax deductions. It's also the nastiest nasty gram the IRS will ever give you. And here's why it's both. The IRS lets you play a game of pretend. And they say, if you're going to hold real estate and you're going to use it for investment or heavy equipment or whatever, and you're using this for investment, you're helping our economy grow.
Hmm.
So we're going to let you pretend that that house is going to lose value and it's going to lose 1/27 and a half of its value every year. What's the significance of that number? I don't have a clue. I don't even want to know. But 1/27th. So $100,000 house, roughly $4,000 in depreciation.
every year, right?
each year that you get to take off as a loss.
Hmm.
But remember, it's going to be a pretend loss, probably, because ultimately, aren't you going to make money? That's the
Right.
goal, right?
Yeah.
Appreciation. But you get to write it off. So a lot of people will use depreciation very effectively to mitigate their current tax bills. Now, there's phase outs on that as well. For high net worth earners, there's phase outs depending on how you're investing, whether passively or not. And but there's also certain things you can do, like becoming a real estate professional.
And phase outs, it's just like decreasing over time.
Correct,
Yeah.
correct. Now you don't lose the depreciation, but it becomes stagnant until you reach the phase out again.
Okay. Hmm.
And then you start drawing from it again. So you don't lose it. So a lot of people will say, fine, I'm a high net worth individual. I know I don't get to use this depreciation now, but there's going to come a time when I have to start taking required minimum distributions.
Hmm.
Maybe that's a good time to start to offset
Okay.
and keep that depreciation going. So there's a lot of reasons why it's good. Here's why it's really, really, really bad.
Mm.
The IRS doesn't give it to you forever. If you sell the house, they say, we want you to pay that back.
Oh, really?
Yeah, how's that for nasty? So you go for 5 or 6 years and you've taken $30,000 in depreciation and you sell the house and the IRS says, oh, we want $18,000 of that back.
Got it. How is there whole calculations based off of how much they want back? Because you said if we took 30,000, they may want something like,
Yeah, I'm
I
sorry,
believe
it's
the
probably more like 8,000.
okay,
It's taxed at 25%.
got it. Okay. So
Yeah,
they'll want a fraction back.
exactly. So, but that's also the same fraction that you actually took off as your loss.
Right.
So at the end of the day, if you sell it and just pay it back, you've benefited yourself nothing.
Right. Net zero.
And this again is why the 1031 exchange is so important. Because when you sell your investment property and you go and buy new investment property,
Hmm.
you get to also indefinitely defer paying back that depreciation.
Got it.
So it's
So
not just the profit, it's the depreciation.
so you're talking about, not to split this off in too many topics, but there's a lot of questions running through my head right now. One of which is we're talking about depreciation. Correct me if I'm wrong here, but the it's basically understanding that things will age and knowing that because they're aging, they're losing their value over time. Is that about right?
Yeah, that's exactly right. That's the theory.
Right.
The reality is that, especially with real estate, that generally doesn't happen.
Right. And we're, yeah, but I just wanted to set a loose definition, right? Theory of it. And that 27 year, 27? Yeah.
27 and a half years for
Right.
residential property.
Exactly. And so I do interviews a lot with people in commercial ready all as well, whether that's multifamily or RV or mobile home. I've got some people coming on for self storage here soon too. But all those have their can be depreciated as well and different. Or do you know if it's similar timelines?
Commercial real estate is over 35 years.
Mm-hmm.
When you're talking about personal property, there's actually this 2-inch thick document, the standard, I can't remember what it's called now, but it has every type of property, whether that's a chair, a table, piece of real estate, or an airplane. And it's assigned a number, the North American Classification Code, I think it was. And that number tells you how long it can be depreciated over.
Hmm.
For instance, a computer, you might get to write it all off in 1 year. A
Hmm.
conference table might depreciate it over 5 years. Real estate's 27 and a half when it's residential. If it's commercial, it's 35. So you
Yeah.
got all those different things running around. But This is actually this leads into another really fun aspect of this. When you're talking about real estate, just property in general, first of all, there is also a thing called, for right now, the 179 deduction.
I haven't heard of this one.
179 allows you to take a piece of property not more than $2 million worth, and as long as it's used for investment or in your business, you get to deduct 100% of the value
Hmm.
in the year you buy it.
So this sounds completely different than bonus depreciation.
Yes.
Okay, so 179. Let's stay on target. So,
Yeah. We'll talk about bonus depreciation and cost savings in just a second. That's the other half of how it gets really good. It actually is one form of bonus because instead of making you depreciate it out over years, you're getting to depreciate it out immediately.
so up to 2 million, something. What is the classification? Up to 2 million. That as long as it's investment purposes and it's equipment or something.
I did it with a lens grinder for my son's optometry practice. We bought a tiny home that we're using as an Airbnb,
Nice.
but it's on a trailer. So it's not real estate, it's a vehicle. Because number one, I could not build anymore onto my site, but I was allowed to put a boat on a trailer. So I put a tiny house on the trailer. But because it's not real estate, it qualifies for 179. And we're using it as an Airbnb, a rental, and a mobile office.
See,
Those are the things that the IRS is incentivizing you to do.
these are the things that
This
crack
was
me up.
appeals.
You were telling me last time around about how you were classifying a certain thing with your boat last time around. I think it was the slip or something for the
It
boat
was
that
real
you're.
estate, yeah.
Yeah. I was like, that's brilliant. So,
Well, by the way, if you want to buy a boat, and you can treat it as you can either live in it or it could be a vacation home for you, which you're allowed to have. And as long as it's got a place to cook and a place to go to the bathroom, you can deduct the mortgage interest.
dude, that's wild.
I know.
Yeah.
Crazy, right?
Yeah. I love taxes.
But that's how depreciation can benefit you and how you can actually take. Now, that all of this bonus depreciation stuff
Yeah.
started in 2017, remember?
Hmm.
When President Trump took away the 1031 option for personal property and
Mm.
made it only for real estate. Why did he do that? Because then he wanted, I think, he wanted to write off his 747 entirely in that year. So he buys a new 747, writes it off 100%, or at least $2 million of it
Yeah.
in the year that he bought it.
Got it. And this is about the 179.
Yes. So that's one of those things the IRS took away personal property for the 1031, but they gave you 179 and bonus depreciation.
Got it. So they took away the 1031 for personal property. They gave the 179 and depreciation, bonus depreciation. So let me just ask, why do you have any insight as to where the 179 is used? Like why you would use it? Like you talked about, your the home on the back of the truck, that's an Airbnb, but like where else would you see this being used and like why did they even do that?
Well, anytime any company or investor has windfall profits in a given year, it'd be nice to have windfall depreciation, wouldn't it?
Yeah, for sure.
So I had a decent year last year. Well, why don't I buy a lens grinder for my son and a tiny house on wheels?
Got it. So it's a way, it's a strategy and mechanism to offset in case you come across a bunch of cash you weren't expecting.
Exactly. Why does the IRS like it? Why would the IRS incentivize you?
The same thing that they would want for the rest of their giving out cookies, which is they want economic growth.
Exactly. That lens grinder is only in service today because I was able to write it all off.
Right. Because you're able to buy it, and you're able to use it, and able to do something with it and create production of some sort.
So, what a great incentivizer that is. Now,
Mm.
there is another way that depreciation works with real estate that's so awfully cool, and it's what's called a cost segregation.
Mm-hmm.
I couldn't even tell you when this became vogue, but it's been in the last 15 to 20 years, I think. It used to be done with really, really large assets. I mean, big office towers and that kind of thing.
Yeah.
Um, but in the last 15 to 20 years, it's become really popular for syndicators
Yep.
and really popular for really anybody that's buying large real estate assets
Yeah.
that are construction heavy, and in particular, vacation rentals. And here's why: cost segregations take a piece of real estate, and instead of saying, well, the building you get to deduct depreciation over 27 and a half years, the land you don't. The land just sits because it doesn't depreciate. And it says instead of having real estate and land, what you have is land, and you have a component, you have this structure that's made up of all kinds of things.
Mm-hmm.
You have windows, you have copper wiring, you have carpet, you have all these things that when you put them all together, it's a house.
Right.
Separately, it's
Yeah.
not a house.
Right.
And so it's separated out because that copper wiring might have a 5 year depreciation life.
Mm-hmm.
And if you can get enough of those things, all of a sudden you've deducted, instead of taking 27 and a half years, you've condensed that down to 10 years.
Yeah. A lot more of it more immediately.
Right. And with high net worth individuals, because of those limits on regular depreciation, it's difficult to take real advantage of it. But when they go into vacation rentals, that's considered active investing. So they get to take the full depreciation against their profits on that property.
So interesting. Let's put an example around this. So you talked about bonus depreciation and taking a lot more depreciation earlier on, right? Like the first year, second year. I mean, I know the percentages are changing right now, but let's assume that it's being taken in the first couple of years. So it offsets um, the depreciation that you get offsets, the income, right? Um, so let's think about this from the syndication play, right? So in this, I wanted to carry over what you said earlier about when something gets sold, the IRS wants a percentage of it at sale. So what I am trying to understand here in this question is, let's say, a syndicator for a multifamily goes out, right? And they get this apartment complex, right? And they do this cost segregation study, and there's to get depreciation up front in the first 2 years or something like that. Okay. And so they're taking a lot of depreciation up front, but at year 5, when they go to sell this thing,
Yeah.
they have to pay a percentage back. How does that impact them or the investors?
Very negatively.
Yeah. Yeah.
People don't realize this so many times because it's a trap that you can fall into. They buy a $2 million property, they cost segregate, depreciate $1 million of that.
Mm-hmm.
Well, what that means is that when they do that, the basis in their property, what the IRS looks at as their starting basis, is now $1 million. So then they sell it for 3 million. Well, they just made $2 million. $1 million of that is depreciation that has to be recaptured,
Mm-hmm.
and $1 million of that is pure profit. So that's why it comes back and haunts you unless you can do the 1031 exchange.
So, so it was they got it for 2 million, did depreciation 4 million, and then sold it later on for 5?
or three,
For 3, yeah,
whatever.
okay. Perfect.
So they
Now the
sell it
numbers
for
are making sense.
three.
Yeah,
They didn't just make $1 million. They didn't
they
buy
made
it for
2.
two, sell it
Yeah,
to three.
got it.
They made 2 million. Yeah. Now, when you do a 1031 exchange, if it was just an individual that bought a property for 2 million, did a cost seg to 1 million, then sold it for three, they would pay zero tax.
Because if they're using 1031 there.
Exactly.
Okay. So in which case, the cost seg would still be a good play there if they
Oh
use
yeah.
1031.
And what are they going to do? They're going to sell the property for 3 million.
Hmm.
Then they're going to go buy a $6 million property.
Yep.
And with that extra 3 million, we call that additional depreciable basis. And they're going to do a cost segregation on that additional 3 million.
The
They
additional
take
3
it right out.
million, right? Because if they went to go buy a new property sales price of 6 and they rolled over all 3, let's say,
Yeah.
then that's that additional on that remaining 3 million from the six
Yeah.
million dollar price
So
tag.
remember, the basis when they started was one.
Yep.
And then when they bought the property for six, they got it. That's an additional $3 million of basis. So that brought their basis up to four.
Hmm.
But then they did another cost seg to take out the 2 million. So now their basis is 2 million on a property they just paid $6 million for.
Got you. Cool.
If they sell it the next day, they got a $4 million profit.
Yeah.
They sell it the next day for 6 million.
Right.
So there's a lot of incentive to keep that train rolling and let the depreciation benefit you until you finally die and it goes away.
And that's why you do what you do.
Yep.
Seems like everyone should, if you keep on trading smaller greenhouses for bigger greenhouses, and eventually later on you roll that into an apartment complex as an example, like that seems like to be the thing that everyone should do.
Uh,
Air quotes, everyone.
yeah. I mean, yeah. There's a good model for everybody,
Yeah, yeah. Hmm.
and it that can still accomplish the same thing. What if you made your model instead of growing larger in singles to go larger in multiples?
Split off. Yeah.
And then your retirement plan, every once in a while, I sell a small one.
Right.
So
You
I take a
mentioned this.
tax hit.
Yeah,
I
yeah,
take
yeah.
a profit, whatever. I'm tired of being a landlord, anyways.
Right.
So that's my retirement gig. So
Mhm.
if I sold just the one large asset, now I got problems, don't I?
Sure.
But if
Yeah.
I sell one out of 25, yeah, okay.
Or that boat. Get that boat with the slip.
Exactly.
um. Okay. Cool. That was a fun detour into depreciation. The 179 talking about bonus depreciation as well. So I
You know
guess
who
the
your best friend in those is?
hmm,
Depreciation is a labyrinth. Your best friend is your accountant.
got it.
And accountants are just like attorneys. A a good attorney knows the law. A great accountant knows the judge.
Mm, got it.
So go find a good accountant that knows the law and the tax code, but you also want the one who knows the backdoor numbers.
Yeah. I think it's a great kind of capping off of that too, because there's so many different variables. But right, but being aware of that, and if you do see a deal or something like that you want to invest in, albeit many of the listeners here are passive investors, which is why they're listening to this too, as well, is to understand how it works for their own situation. But if they spot deals that say things like bonus depreciation as well, is like, is that a good play for me? Does that fit with my
That's
strategy?
exactly right. That's exactly right. It sounds cool, but is it really going to help them in their tax situation?
Right. Got it. Cool. That makes all the good point. So what one of the things that's sort of curious is what types of expenses end up being tax deductible, right? You talked about the 179 as an example. Uh, is there Do you have any general guidelines or general thinking points for someone to think about like expenses versus what might be tax deductible?
That's actually a pretty important consideration because there's actually two different levels of what we would call expenses. And the first level are actual expenses that get not depreciated, but they get deducted in the year that you do them. So if you have to call a plumber out and they're fixing a clogged sink on your rental unit, well, that's an expense.
Mm-hmm.
That's a repair on something that's broken. Why is that a good thing? Not because it happened, but it's a good thing because you can deduct that off your income in that year. So it's important to keep track of those kinds of things, right? The other type of expense you incur is what's called a capitalized expense. These are generally, and it's hard to put a fine line on it, but they're generally things that are more expensive and last longer.
Mm-hmm.
So a new roof is generally going to be a capitalized expense. You don't get to write it off in that year. Well, that's a bummer because you paid a lot of money in that year for it.
Yeah,
But you get to add it to your basis. So you get to start depreciating it out as part of your property.
got it.
And they can both be good depending on where you're at. A lot of times people will want to have as many things listed as expenses in the current year as possible because that's a bigger tax break. But you just have to be careful that they're legit. And again, who's your buddy? Who's your pal?
Accountant.
Your accountant. And my second advice, besides not just finding an accountant that knows the backdoor phone numbers, find an accountant that's not as strong as you are. So you can arm wrestle them to win the arguments.
As long as it's according to code.
Well, yeah,
Yeah.
absolutely.
Yes, yes.
There's a lot of in any industry, there are those who choose to ask forgiveness.
Yeah.
There are those who choose to ask permission. And sometimes the tax code doesn't even tell us which it is. So there are accountants who are going to be more aggressive. There are accountants who are going to be less aggressive. There are accountants that are going to be cowboys from the Old West. Avoid those and pick your poison between the two. But if you've got an aggressive bone in your body, find the accountant who's going to meld with you good, or the one who, again, doesn't have as much bicep strength so you can win arguments.
So, in these capital expenditures, let's say at the wanting to sell this thing later on, right? In this case, we aren't doing 1031. Like, because if you are doing a 1031, then you would go ahead, then you would be able to off. What's the terminology? Not offset, but just roll the depreciation as well.
Defer it. Yeah, you're deferring. Yeah.
Defer. Okay. But again, just following the general principles that if you did sell, then you would have to, and you were you did CapEx expenses or capital expenditures, you would have to pay back a portion of what you depreciated from that as well.
Yes, that's correct.
Okay.
But the chances are that when you added that, you put a new roof on it. You don't get the benefit right then, but you sell the house 2 years later. You put a pool in for $100,000, then sell the house a year later, where you've only taken like just a small amount of additional depreciation, but it increased the basis of your house quite a bit, hopefully enough to offset the additional value of the house.
So the basis being the value.
The basis being the actual dollar amount that you added to what the IRS says is the value,
Cool. Yeah. Yeah.
the starting value of the
Yeah.
house. Yeah. it gets deep, doesn't it?
Yeah, it does. And just making sure that the terminology is, keep it simple, keep it, especially as the concepts are coming together. It's like, all right, do I have to define that thing? Define that thing? But
I
yeah,
tell you
it's
what, an investor's never gone wrong by asking more questions. People get started, they just start moving. And it's like, ask questions, ask questions, ask questions. I know that you pay for your accountant's time. It's well worth it.
absolutely. Where do you see people going wrong with this? With I think last time we had talked, wanted to do 1031s. It's making sure you have a good intermediary, right? Would be one thing. Making sure that you have properties, regardless of size, whether that's the single family investment or something bigger, that you have uh, target properties within a period of time. Um, is that the same? Is that the the timelines and having your properties picked out? Is that the same for like a multifamily as well?
Yeah, absolutely. The 1031 exchange is for any type of investment real estate.
Okay, any type of
But
investment real
one of the
estate.
cool things is we talked about shaping your portfolio earlier.
Mm-hmm.
You can't sell any type and any number of investment properties and exchange them into any other type and any other number. So you can sell single family rentals and buy large multifamily. You can sell a large commercial property and buy a bunch of small vacation rentals, all using the 1031 exchange. So it works really well to shape your portfolio.
What happened? Does so it has to be of that value or greater?
If you want to defer all tax,
Yeah,
you have to purchase at least as much as your net sale. Yeah.
at least as much as net sale. Got it. So if your net sale, whatever, 3 million, sell it. You had if it was 3 million, you had 1.5 worth of debt on it, and your net sale was 1.5, then you have to buy at least 1.5.
Yeah. Yeah. Then the second half of that rule is you have to wait. What they sell it for?
Uh, if if they sold it for 3 million and they had 1.5 worth of debt.
Okay. I misspoke. They got to do two things. They first have to purchase at least 3 million
Okay.
because that's their net sale. It's contract price minus closing costs and commissions. The second thing they have to do is use all of their proceeds, 1.5, to
Yes.
do that.
Okay. Got it. So they have to buy the same amount of value as was the original property value, the 3 million, and they have to use all of the net proceeds, which is the 1.5.
Right.
Okay.
Right.
Got it.
Think about syndications, though. This is something kind of cool.
Mm-hmm.
Is because you can buy any number of properties. If the syndication is able to accept your money because you're buying it as a tenant in common, so you're buying actual real estate.
Mm-hmm.
What if you took, say, $750,000 of that and bought a vacation rental house free and clear,
Mm-hmm.
and then you took another $400,000 and bought another rental duplex free and clear,
Yeah.
and then took the other 400,000, 450,
Mm-hmm.
and used that to go buy something with leverage.
Right. Mm-hmm.
Okay. So you've got two properties free and clear. You got a property with leverage. You bought at least 3 million. You used all of your proceeds. And then what you're going to do, because you want to invest in syndications, is you do a refinance of one of the two free and clear properties.
Mm,
And you pull the cash out, and now you can invest in a syndication tax free.
yeah. Backed by those two homes, which is the whole very similar of, I mean, at least in functionally is kind of be your own bank as well.
That's exactly right.
Yeah.
It's no accident that when you look at any urban downtown, the 70-story towers all have somebody's name on them, right?
Mm-hmm.
A lot of times it's investment companies, investment banks, that kind of thing.
Yeah.
Well, that's really not so much an office tower as it is collateral. They're using that office tower as collateral to pull cash whenever they choose to go do whatever it is that they do. Wells Fargo is not a real estate investment company, but they use big real estate to fund their activities for profit.
Yeah. It's a business. They just keep pulling cash out.
Between pulling cash out from that and from you and I, yeah.
Yeah. Yeah. Um, all right. Just processing that one for a second. So I love that example, using the proceeds to go and buy, things free and clear, and then, refinancing those to go invest in other things. I mean, the if you're at that level of sophistication, then you would have to be at this level of sophisticate. Well, I would hope that you're educated enough to know what a good deal looks like, so that you're not losing your, what you refied and what invested that money
Yeah,
into,
you would hope,
right?
for sure. Of course, the nice thing is when you do that also, though, you're putting eggs into multiple baskets, aren't you?
Hmm.
So you've got to have your money off on the side here in something that hopefully you underwrote well. And then you've got money in a syndication that hopefully you underwrote well.
Yeah,
The odds of both of them going bad are less,
sure.
theoretically.
I'm curious about like the tax, like on the annual taxes, as an example. So if someone does that, so let's just stick with that, like that, like continue on with this analogy. Then we have, those two houses that we paid out, bought free and clear, and then we stuck a tenant in, right? Because they're investment property, and you know, their tenants are paying on those, and so, um, there's obviously, banks that put loans on each property, tenants are paying on them, and so that's pretty straightforward of just rental income, right? If and so we would have, as an example, each of those houses in their own LLC. Would you suggest, just fully disclaimer, none of this is, asset protection, all that kind of stuff?
I've done it both ways. I put properties in my name, I put properties in LLCs. I've never been sued. I don't know what that proves. I don't have a clue.
Okay, good answer, Dave.
It's like
No-
the Cleveland Indians fan, right? Where you swear you can influence the outcome of the game by beating the drum a certain way. I mean, it's who knows?
Got it. Go ask your lawyer. Got it.
Who knows the judge? Yes.
Yes, yes. Okay, perfect. But let's say there's some level of, they're in some kind of entity, because we want to, have some we're thinking about asset protection there. What the investor needs to be thinking about how they would have to do their taxes at the end of the year, which is really the outcome I'm driving to. Um,
Got it. Um, let's back up. I love that question. That's gonna be fun. Let's back that up because you also just mentioned something about the investor hopefully having sophistication
yes.
to know what they're getting into.
Hmm.
So before I have tax to pay, I got to have a profit, right?
Yes.
So you mentioned cash flow and all that kind of thing. There is what I think is the be all end all Mac Daddy
Mm.
of all financial calculations. This enters into every part of my life, whether I'm buying real estate or a car or a business or washing dishes. It's called the internal rate of return.
Mm.
And what the internal rate of return, IRR, stands for is the sum of all of the ways you make real money on an asset. Now, I jokingly said I do it even when I do dishes
Hmm. Sure.
because when I do dishes, this is the simplest example, you'll get it. I'm not just cleaning the kitchen, am I? I'm earning goodwill from my
Yes.
wife.
Yes.
I'm freeing up plates so I can put more food on them.
Yeah. Currency.
I'm also making the kitchen look clean. So there's numbers of different benefits, right? So with real estate or a business, check this out. You've got the cash flow, don't you?
Mm-hmm.
Which is the amount that you're getting in actual money from renters over your expenses every year.
Mm-hmm.
There is also, and it's a very real cash benefit to you, but you don't get it immediately. There's also appreciation, isn't there?
Mm-hmm. Yep. On the house.
When you finally sell that, you're going to get, if you've underwritten it correctly, you're going to get more money than you paid for the property.
Mm-hmm.
That's cash flow to you. There is the amortization of the loan. This is because if your tenants are paying you, if your mortgage is $1,000 a month and your tenants are paying you 500, 1,500 a month, 500 is cash flow, 1,000 is your mortgage. But your mortgage is broken up into two things:
Principal and interest. Yep.
return of principal and interest. So the amortization of the loan says that you're getting all of those principal dollars back, but they're not coming from you, they're coming from your tenant.
Right.
Then you're also going to get the tax benefit of the mortgage write off.
Mm-hmm.
And then there's the final, well, another prong could be it's a multifamily and I have a washer and dryer that are coin operated.
Mm-hmm.
That's a cash flow,
Other income. Right.
other income. Uh, there's a certain amount of covered parking.
Mm-hmm.
I can rent that out. There's certain units have lockhouses. All anything that can be used to make money are the components of the IRR. The last component is depreciation. Because while I own that property, that depreciation lowers my tax bill, and lowering my tax bill means I pay less taxes, and paying less taxes
It's money
is
saved.
the same as making more money.
Yeah. A penny saved is a dollar and kind of thing. Or is it?
Exactly.
Yeah.
So look at that. We just listed 5 different components that all have to be looked at. When you add those 5 together, they'll give you a dollar amount. And that dollar amount you divide either against the value of your asset or against the amount of cash you have invested in the asset,
Mm-hmm.
depending on what your preference is. Return on your equity or return on the asset or return on your investment.
Right.
And that's how you underwrite a deal. So many people go into these things going, I can get this property's going to cash flow me $500 a month. It's a great deal. I'm going to get it now. But they're going to pay so much in interest, or they didn't factor in vacancy or repairs or something
Yep.
that's going to bring those returns down. And that's why you got to look at all 4 of them, because there's actually a recent podcast, several recent podcasts my clients have actually gone on who are high net worth individuals. And they went on because they were talking about the fact that they don't care about cash flow.
Mm.
They're getting good cash flow for their W 2 jobs. Usually they're medical professionals or software engineers, that kind of thing.
Yep.
But their internal rate of return is still huge because they're getting depreciation, they're getting appreciation. So they don't invest for cash flow. They go invest and try not to make money into areas where they get greater appreciation or where they can borrow more money, even though that's at such a high interest rate that they're not going to make any money by the time they pay their mortgage, because the appreciation, the mortgage write off, and the return of principal from the tenant are all things that they can bank on that aren't going to be taxed for them if they do a 1031 exchange.
All right. So we have a lot of tech professionals listening in, software engineers, architects, et cetera, et cetera, et cetera. Um, and is the property that you were talking about, we're still following an analogy, was a single family home investment. And it doesn't matter if it was other real estate because you mentioned things like laundry and parking lots and stuff like that as well.
I mean, yeah, it could be any kind of real estate. Another little clue, though, is that typically for most of a market, the fastest appreciating asset are single family homes.
The 27.5 year, is that what you're referring to?
A lot of these people will love to go into single family houses because they're getting more appreciation. Appreciation isn't taxed till you sell.
Right.
So they can sit there for years making tons of money, but never paying a penny in tax. They're just not touching that money because it's all in appreciation and loan pay down by their tenant.
Right. So they're making money that way, but they don't have access to their money unless they were to 1031 it, or
Get access
refinance.
anytime they want.
Refinance.
Refinance, yeah.
Yeah. Okay.
But remember, they're high net earners
Hmm.
with W 2s.
Don't need the money.
So that just becomes another way of earning for retirement.
Got it. So that's how we're saying, quote unquote, earning it because it's increasing in value, so it's being
It's
earned.
real. It's as real as the sun rising in the east.
Yeah. And just
And you,
like the
but you
loan
got to
getting,
wrap your head around that,
yeah.
don't you? Because so many of us are just trained to think money that I make is money I touch. It's not.
Yes, I would agree. I was just making sure that I was really separating it out from like you were talking about earlier, cash flow. It is absolutely real, just as real as the loan getting paid down as well.
Exactly. And that's why you look at all the four prongs. Cash flow is just the cash that's going into your pocket over and above your expenses every year. For high net worth earners, they don't even want that.
Right.
For mom and pop, for me starting out, whatever, cash flow is important.
Absolutely.
But it just because it's got low cash flow doesn't mean it's not a great investment. You got to factor in everything else.
So, um, just to add a point there, because one of the things that uh, just to add a point there, that money is being earned by the cash flow, if any, by the appreciation, by paying down the loan, and that's all real increase in value, right? um, which in a way is, well, of course, if it's increasing in value, it's also increasing in net worth as well. But let's just say increasing in value, and will be realized on the sale, and of course using 1031 as well. But none of this helps with uh, offsetting any W-2 income because that's a completely unrelated topic.
Correct. Correct.
Okay.
Yeah, W 2 income, we could go into that for days and weeks, years. Whole different animal.
One more time.
We could go into that for days and weeks and years. It's a whole different animal,
Got it.
which is why I don't do my own taxes.
Mm.
I have an accountant who does my taxes because just like the whole attorney thing, the accountant who does his own taxes, the attorney who represents himself, the surgeon that does his own surgery, they have a fool for a client.
Got it. Uh, we touched a lot of stuff today, man. The hour went by really fast.
It was fun. Yeah, you went some deep places, and it's hard to keep it surface and understandable. But that's really the great challenge, especially not just for a starting real estate investor, but even for an experienced one. You don't want to be the accountant for your enterprise. You don't want to be the attorney. You want to be deep enough to know the questions to ask.
Right.
And then you assemble the team, and the team gets you over the finish line.
Yeah, absolutely. I think knowing, let me put it this way, knowing a lot of my peers, I think they would appreciate this level of depth because it takes the basics, but also enough to like, oh, cool, I got enough, and yes, questions, but they're all technical minded, and so like this is like, all right, cool, like I got it. um, what didn't we cover that you want to add?
Wow, that's an open question.
It is.
And there's so much. We did not cover how desirable U.S. Virgin Islands real estate is. And the fact that you can 1031 into the U.S. Virgin Islands, and the fact that if you use me as your QI, I go there personally to make sure that the transaction goes smoothly.
Is that something that you have clients like software engineers and them use as well?
Oh, yeah. Uh, Guam, the American Samoa, the Northern Marianas Islands, and the U.S. Virgin Islands all qualify.
Do you have a blog or something on that to your knowledge?
I don't. It's
Okay,
in my classes that I teach and all, but because they're all U.S. territories.
got it. Well, I was gonna leverage that for something else, but I don't know. I'll ping you in a couple of months, see if you want to come back and talk on that too, Dave.
Well, I mean, just don't forget the last statement. I volunteered to go there personally to make sure your transaction goes smoothly.
Mm. And you can have investment property for there.
Yeah, absolutely.
Yeah.
Yeah, we have people who will sell and buy there. They'll sell there and buy in the States. It's a regular process. Pretty amazing.
We'll have to talk about that. Yeah, I've got a little teaser for next time around. Outstanding. Well, I really appreciate you, Dave. As always, I appreciate your the energy you bring to really educate and explain things and keep it at that level of understanding, and just the specificity of how you cover things is awesome to be on a podcast like this too. So I really appreciate you.
It's always fun chatting with you. I never know where it's going,
Yeah.
but it's always fun.
Outstanding. I have the links for you. Is there anything else you want to mention, or it's just the standard links as well?
Yeah, come see us at those links, the 1031investor.com.
Cool.
Lots of free education. And man, we love to talk to people.
Perfect.
We really do. I've learned over my life it's so much easier to avoid problems
Mm,
than to solve problems.
100%. I was looking through your site as well. I found some great blog posts. I'll make sure those are in the show notes too. Please reach out to Dave. As you can see, he's a wealth of information. So, Dave, once again, appreciate you, brother. Thanks for being here. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.